But if I look at your finances, you got 423 million bucks of debt as of March. I don't know what it stands at today. You've got a big credit facility which you've drawn down 92 million of. Talk to me about the finances and what you're going to do. Do you need to clean things up because you're telling me there's a lot of money coming down the line?
Yeah, I mean we have net income of over $100 million a year right now. We did draw down $50 million from our facility during COVID-19 when we didn't know which way the world was going. Subsequent to that, Investment Quebec, the government of Quebec, put an $85 million private placement in at a 10% premium to market. So, great shareholder. And Quebec is the most proactive mining government in the world. They're the only ones that actually will write a government check to be equity partners with you. So we have a home court advantage of being what I believe is the best mining jurisdiction in the world, with the most supportive government, and they own collectively 22% of our company. So we are unique in that we do have a huge shareholder that backs the play, and they participate with us in different deals. The Case Depot has a right to participate up to 20% in certain deals, depending on the condition, directly with us, which sometimes they do. So we can talk. We cast a much larger shadow than we do, and we've also been able to work debt directly through the pension plans at lower cost than some of the other groups. So we can bring both equity, debt, and the royalty money to the table, and we're just in the process of maturing that as we go through it in a couple of next steps. But reality is, we've been able to position ourselves, and it was all about getting those core real estate positions. There was more drilling on our royalty lands last year collectively than there was almost in the rest of the world, because Canada was drilling and everybody else was shut down. So that's a big advantage for shareholders, is that every time the drill bit turns on one of our royalty lands and we don't pay for it, it's upside for us. Okay. We've had significant discoveries.
What do you or the board feel any pressure financially? Because I know you just got Investissement Quebec to put that money in as equity. Is that what's driving the confidence here? Because again, I'm just trying to get back to why aren't investors, some investors behind you with this vision that you have, if you've got the financial, ability to help you deliver these things.
Yeah. So we're actually net debt zero if you look at our cash position plus our equity book. So our equity book sits at around 300 million. Our cash position is slightly over 200, and our net debt position is there's $350 million in convertibles, which 300 is due in 2022. So it's not exactly next door. And then the rest of it's on our acquisition line, which we are in the process of using for acquisitions. So we're pretty comfortable with our balance sheet. We try to run a net debt zero basis balance sheet. So that's where we sit right now. Obviously, one of the big equity positions is the Osisko Mining, sits over 140, $160 million on a mark-to-market basis. So that's why we're pretty relaxed about where we are. The way that we put the debt on our balance sheet was we did a $1.1 billion acquisition from Orion for a royalty portfolio in 2017. So the debt didn't occur because of anything except building NAV. So we got NAV when we did that debt exchange. And we built our GEOs up to 80,000 ounces a year. So, it's a pretty good ratio when you look at it symmetrically in terms of the balance of things. And we try to maintain that, close to our positive zero, net debt zero. We will pay back debt as time goes by. We've paid down $350 million of dividends and share buybacks. In 2019, we bought back 8% of our stock from Orion with the share exchange of our equity book for $174 million. So we've been pretty proactive on our balance sheet management.
Okay. But for,
I'm an old country boy. I don't like that.
Well, yeah, no, but for a $2.5 billion company, net zero is that where you want to be?
Well, listen, it depends on why we're putting debt on, right? So, I'm willing to put debt on if we have producing assets that we're acquiring. I'm not really, too keen to put debt on in terms of medium to long-term opportunities, but for near-term opportunities, that's what acquisition lines are for. And traditionally, most of the royalty companies do use their acquisition line and convert to debt because it's a tax-efficient way to do things. The other thing that I would say is that, we have huge tax pools. We're onshore dominantly. But through the Canadian flow-through share basis, the reason that we run such a big equity book is that when we purchase those equities, we can use that tax protection that comes with flow-through shares to protect our tax pools. And we started with $50 million worth of tax pools. We've made almost $800 million in revenue onshore, and we still enjoy tax pools in excess of $350 million. So tax management is a big thing for us, and we don't have any CRE issues outstanding. And we've been able to do a model that's a little bit different than others, but highly tax efficient. When we buy equities under the flow-through model, if it's federal, it's a minimum of 22% gain. If it's provincial and we happen to be in Quebec, it can be up to 50% premium. So if you pay $1 for a stock, we execute the same transaction using flow-through, we would have only paid a net of 50 cents for the same equity that you bought. So it's a bit unique, a bit complicated, but it saves a huge amount of money for us and makes a marginal asset look pretty good.